Today, we're talking IPOs, initial public offerings. Should you participate? You want to get in? How do you do it? Let's go. Let's get into it right now. Hey guys, I'm Rob Tatro from robtatro.com, portfolio manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Thanks for tuning in. IPOs, initial public offerings, really sexy term. You don't know what it means. Let's go. Let's get into it. So first off, before we do that, take a sec to subscribe, like, share, give us a follow. We value and we want to get to 10,000 subscribers. So give us a quick follow. With respect to IPOs, you've heard the term, you don't really know what it means. Initial public offering. So typically companies start out as being a privately owned company. So you and I, we start a company, whether it's a manufacturing company or a tech company or an e-commerce company, we start a company. Over time, we grow. We have more and more sales. So at some point, we'll reach the point where the company is too large for us to either sell, or maybe we would just want to liquidate a portion of our company. So our company doesn't trade on any exchange. It's personally owned by just you and I, and maybe friends and family have some shares. And maybe, over time we've added some key people as partners, but let's say you and I own the majority of the shares. Well, we'll get to a point where venture capitalists will start calling VC firms and they'll say, you know what, Rob, I want to buy 10% of your company or 20% of your company. That remains in the private space. Okay, so maybe we raise a little bit of capital that way, but eventually what all companies or most companies seek to get to is an IPO, the holy grail of making it in the business world. That means you are selling your shares with an initial public offering to the public market. You're raising capital, so it might be 5% of your company or 2% of your company or 10% of your company. You're selling those shares, you're getting capital, and in exchange for that, you are divesting a portion of your ownership. So they provide the opportunity for us, you and I as business owners, to access the best market for capital, the primary market, which is all of investors around the planet. So currently, if you and I want to sell our business, we're private. We have maybe 5 or 10 venture capitalist firms that are coming, knocking on our door, maybe if we're lucky. But once we're on the market, in exchange of some sort, whether it's the S&P, the Dow, the NASDAQ, the TSX, or foreign exchanges, now we have access to all of those investors that are on there. So typically, we would hire an investment bank, and the investment bank would gauge demand. They would do road shows. They would fly around the country and talk to investors, talk to investment firms about how great our company is. And they'd say, this company is worth a ton of money. You should buy it. You should get your clients to buy it. And they will pay a commission typically to the investment broker, the stockbrokers, the investment advisors to sell the idea of this stock. So the idea is that they will price the IPO at a number that they think will be extremely attractive for investors, but they want to get the most possible dollars from that investment for you and I that we're taking our company public. It's a balancing game that the investment bankers do. And honestly, it's pretty complicated. But if you do want to learn more about how these fit into your portfolio, go to www.speaktorob.com. We'd love to book a no obligation consultation to chat with you about this. Okay, so now they've priced the IPO. All right, so they say it's going to be $10 a share, Rob. And we think, no, it's worth $15 a share at least. But the investment bankers are going to say, yeah, Rob, but we want it to open up on the first day of trading. So let's say we decide the IPO date, it's going to be June 1st. June 1st is the day we start trading. The lead up to June 1st is the kind of selling period, the build up. We're going to do marketing campaigns. We're going to talk to media. We're going to go on BNN and CNBC, and we're going to tell everyone how awesome our company is. And we're hoping to get build up. And then on June 1st, open the gates, the shares start trading. Now, before that, the investment advisors, the stockbrokers, are going to express interest in the shares. So I might say, I want 500,000 shares, or I want 1 million shares. And then my clients will get a portion of that. Now, if all of us advisors or stockbrokers across the country put in way too many shares, if there's a lot of demand, my clients are not going to get filled on their demand. They're not going to get all of their shares. That would mean that there's an excess demand for the shares, and there's only a specific set amount of supply. So that's what you want, right? That's what you want as an IPO. You want pent up demand. You want a ton of demand, people, screaming for your shares. And if that's the case, what do you think happens on the first day that it trades? Clearly, people who couldn't get their shares are going to come in and buy it. And over time, what you want to see is a big bump on the first day and then a continued stability after that. There's some really neat research that has been done on IPOs throughout the last 20 years. Pretty much every average year has generated positive returns on the first day of the IPO. Some years the average being around 10%, some years the average being, more like 20, 30%. I could tell you that in 98, 99, the first day return on US IPOs was about 70%. Last year, that number came in just over 30%, which is a fantastic return for your first day on an IPO. Some years the returns are 5, 6%. We're talking on day one, right? So we're talking on day one. But overall, you do want to see that IPO properly priced, which will then reflect on a positive IPO. The other thing that might happen is you get overhyped. If you get overhyped by investment banks, and they're pushing and they're pushing and they're pushing, that could lead to initial losses, right? So if you get pent up demand and then people kind of start taking profits, they priced it too high, the stock might fall, right? Overall, what we want to see is just stability on the IPO. If you're participating in the IPO, you probably have what's called a lockup provision, meaning that you cannot sell your shares typically for 4 months. So typically there's a 4-month lockup provision, meaning at 4 months, you need to be aware that certain individuals, a lot of individuals, may be selling their shares, especially if the IPO has appreciated. And the IPO now is a publicly traded security, right? It's a stock. So the IPO is appreciated. You hit that 4-month window. Something you need to watch out for if you're participating in IPOs is the expiry of the lockup provision. Because on that day, everyone who participated in the IPO, they are now free to sell. So you could create a whole whack of supply into the market that's liquidating the market that wants to be sold and therefore could potentially drop the price. I want to talk about direct listings because they've popped up lately, and Spotify really kind of pioneered this in 2018. But it's basically an IPO conducted without any underwriters, which means that the issuer, obviously you and I, we have a lot more risk if our company doesn't do well, but we also benefit from a much higher share price. You would typically only do this if you have a ton of belief in the strength of your brand. So we saw Spotify do this 2018, Slack did it in 2019, Goldman Sachs played a key role in both those deals. We thought those did so well that there'd be a ton of buzz around them, but now we haven't seen them that often. And typically the US regulators didn't allow companies to raise their fresh capital through direct listing. Now that's changed a little bit, and the US Securities and Exchange Commission has given them the go ahead to let companies do that. Still not seeing a ton of activity in the direct listing side. So are we going to see more? I don't know. I also want to talk about Dutch auction. A Dutch auction, think of it as a reverse auction. The IPO price is not set. Potential buyers are able to bid for the shares they want to pay, and they could say how much. So I could say, I want 500,000 shares at $10, and other firms could do the same. And over time, you're going to get kind of an equalization of the demand. So Google was the first to do this. They did their IPO through a Dutch auction way back in 2004. Other companies, Interactive Brokers, Morningstar, Boston Beer Company, they also did a Dutch auction as well. Again, you need to be confident in your brand, and you need to be confident that there's going to be a lot of demand for your shares, because the role of the investment banker here is to promote the IPO. So if you don't have the investment banker, if you have very limited help on that front, you certainly don't want to screw up your first time in the market in your IPO. So really interesting stuff, guys. Again, I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Take a sec to subscribe, to like, give us a follow, send us your comments. We'd love to hear what your thoughts are on IPOs, on raising capital, on Dutch auctions, on direct listings. And if you'd like to book a no obligation consultation, please go to www.speaktorob.com. We'd love to have a chat with you about this or anything else in your portfolio or on your mind. Thanks so much for watching. We'll see you in the next video.